Welcome to Clear Perspectives, the fourth quarter 2024 Marietta Market Update. I'm Mary Allmon, Partner and Portfolio Manager here at Marietta Investment Partners. As the fourth quarter gets underway, I'd like to discuss the outlook for the global economy, for the U.S. and global equity markets, and for the bond market. I think the global economy may be hitting an inflection point focused on new growth. Central banks from across the globe are initiating rate cutting cycles, pivoting away from their COVID-era restrictive policies that were put in place to combat high inflation and shifting towards a more pro-growth environment. The Federal Reserve, the European Central Bank, and the People's Bank of China are all among the central banks cutting rates. Here in the US, inflation has ebbed to about 2.5%, and we're forecasting 2025 inflation to be at about 2%. This is well within the Fed's target. And barring any major disruptions to the supply chain or the overall economic landscape, I think this gives the Federal Reserve ample room to continue cutting rates throughout this year and through 2025. We tell our clients all the time, don't fight the Fed, and this is no different. Historically, lower interest rates have reduced the cost of capital and increased investment spending, and broadly led to higher market returns. This global synchronized rate cutting cycle is actually really good for the global economy. We're forecasting global GDP to be 4.2%. That's a pretty big pickup from this year's 3.2%. And much of the underlying strength is actually coming from the US. The US economy is surprisingly robust. Despite calls for a recession or a pullback, we think this is one of the better markets or the better economies that we've seen. We're forecasting US GDP to be 2.5%, and we think a similar clip for 2025. And the strong consumer and increased spending really is part of that. I think that it's essential to acknowledge any risks when an outlook is really this positive. The geopolitical tensions that exist, the war in the Middle East and the Ukraine, the devastation from the hurricane and potentially future hurricanes. And then, there are a number of elections globally, and there's a presidential election here in the US in November. We're monitoring any policy outcomes or news headlines that may be generated from that. But at this point, we really don't think any of those threats are enough to derail our positive outlook. In general, the outcomes for the major economies remain intact. Contain inflation, sustain growth, and ease monetary policy. I think if we shift over to the equity markets a little bit, equity markets have always had they've been a source of opportunity and risk. And this last quarter that we just finished was no different. We saw several pullbacks, only for the market to reach new highs before quarter end. And it's a stark reminder of the inherent volatility in public equity markets. And I like to remind clients and individuals and investors to think about the big picture, to focus on the longer term when making investment decisions. The strong economic backdrop that we're forecasting, as well as the improved interest rate environment, that's actually a really sweet spot for equities. And we think that US equities could rise to new highs over the next 6 to 12 months. And we're forecasting corporate profit growth of double digits in the fourth quarter 2024 and 15+% in 2025. Strong corporate profits are one of the main drivers of higher equity prices. In the international, I think there's also a little bit of a sweet spot of synchronized global rate cutting combined with really depressed valuations. So international equities have not kept up with US equities over the last several years. And I think for a value-oriented investor, this represents a real opportunity given that valuations are as low as they are. As always, I recommend investors focus really on the bottom up here, especially that we focus on companies that have strong fundamentals, strong earnings, strong revenue growth, and try to avoid pockets or areas that would be potentially heavily impacted by the geopolitical issues. We're forecasting, the Fed to continue cutting rates. So we think short-term rates in the US will come down. And I think there's a little bit of a risk that we go back to the COVID era low interest rate environment where we have low returns across fixed income. So tactically, it could be an interesting time for investors to shift their portfolio or a part of their portfolio to lock in a little bit of duration in their fixed income portfolio. Not a major overhaul, but just lock in a little bit of the higher yields that we see right now. Worth a conversation, worth something to think about. As always, we're here to work with you. We're really grateful for the opportunity. If this was interesting to you, please share it with your family, with your friends, and we invite you to join us for a conversation.